Welcome to It's the Economy. Financial markets are entering 2026 with much disagreements over many countries' macros. The US non-farm payroll numbers at 64,000 in November, though above market estimates, is pointing to a weakening demand, as do the US retail sales numbers. There are divided views on the Fed rate cut in January and even, for that matter, thereafter. In India, the rupee's decline is the talking point, with FPIs not entering the market. To understand more about Indian currency, FPI flows and US macros, I have with me Jahangir Aziz, Chief Emerging Market Economist at JPMorgan. Jahangir, thank you very much indeed for your time. First, let's start with the non-farm jobs for November at 64,000. How do you see the Fed reacting with its policy to this data?
So I think, we need to look at, not just, 1 month's data, but look at what's happened in September, October, and November combined, right? So we've had about 105 or 108 in September. We went down minus, 105 in October and up 64, right? So it's still, pretty much at that average level around 50. So if you look at just the fourth quarter by itself, you're running at minus 50. So we had 0 as a fourth quarter average. So it's actually below our run rate at this point in time. I think based on that, we had one more cut, which was in January, and that would be the last cut for this easing cycle before it goes on to a long pause. And we also have actually rate hikes in 2027 in the first half of the year. 50 basis points, 25. So I think that right now it is still on track for a January final rate cut, even though the Fed itself has in the last FOMC warned us not to be too excited about it, right? But I think we are still on for one more rate cut at this point.
They did set the bar very high in the post-policy conference. Now, I'm going to ask you an unfair question because you are, I know, not the equities guy, but how does JPM see the AI trade? Do you see, a big unwind? And I'm asking this because this has implications for the dollar.
No, it has. It definitely has an impact on the dollar. And, when I look at my equity analyst, the equity analyst still has a tremendous amount of faith on AI expansion continuing. I think we have something like $570 or $600 billion of data center-related, AI-related capital expansion that we are pricing in for 2026. That is part of our GDP forecast. And if you look at the past 50, 60 years of history, whenever there has been capital equipment expansion or capital expansion per se in the US, it has always been accompanied by an expansion in employment. Or when capital expansion has fallen or capital has contracted, employment has also contracted. We've seen capital expansion continuing much more strongly than obviously anyone had expected at the start of the year. And we've seen employment coming down. And not only has employment come down, what we've also seen is labor income has slowed down, and so has consumption growth. And you've seen the retail sales number that also came out. I think so there is this divergence that is taking place. And this divergence cannot last long. In our year ahead, we called it a house divided cannot stand. Mm-hmm. That you cannot have capital expansion continuing at this pace and unemployment going down. Unemployment rising. You've seen the numbers, 4.6% this year. So you can have all of this expansion taking place, but if that is not getting translated into higher employment and higher labor income, then consumption will get affected. However, consumption is 70% of the economy. Yeah. If that variable slows down, then it's very hard to see. We have a 2% growth rate for 2026. Very hard to see that getting sustained. But your point is right. It has a significant impact on the equity market, and equity market is a key driver of what is going to happen to the dollar.
Okay, all this dollar was backdrop to my question on the rupee only. For which I invited you. The rupee has been allowed to depreciate and quite sharply lately. Do you see it as an appropriate RBI policy response, or can this fall be destabilizing?
So look, these are value judgments that let's not go into that, right? Whether it's good or bad, right? But let's look at the fundamentals, right? So the fundamentals is that you've had current account deficit, regardless of what caused it, right? Went up from around 0.5, 0.6% last fiscal year to about 1.2, 1.3% this year. That's basically all that is going to happen. You and I have done, I mean, we have been talking about India for a long time, right?
Yes.
At any given point in time, if you had a 1.2% current account deficit in India, we would think it's a great outcome. The problem is that, and this is the challenge is why can't India finance a measly 1.2% current account deficit? We have in the past financed 2.5%, 3% deficit without creating any real headaches, right? Yes. Without having these kinds of depreciating pressure. So my issue is not with the current account deficit per se going up. I know a lot of people are pointing to that, where it's doubled, etc. It's just 1.2%, right? It is the fact that we can't even finance 1.2% of current account deficit, and the culprits are well known, right? You have net FDI, which is skating water. We have foreign portfolio inflows that is barely above zero, right? And none of the Indian corporates are going abroad and actually issuing issuing bonds or raising or borrowing money from them because there's no real corporate investment taking place. Yeah. So I really think the challenge isn't where the current account deficit is where the balance of payment is. And if you have that's correct. And if you have a negative balance of payment shock, then the rupee necessarily needs to adjust to it and be the absorber, rather than let the entire economy be the absorber of that shock. And more importantly, it frees monetary policy from actually having to be held hostage by FX movements. So I think that if the RBI does not allow depreciating pressures to build up and let these pressures vent off, yes, the rupee is going to depreciate, but that's about all that is going to happen. It is not going to get transmitted back into the economy in terms of monetary policy being held hostage, being directed not towards a domestic economy, but being directed towards trying to defend an exchange rate.
Fair point. So you're giving a clean sheet to the Reserve Bank. Well, I agree with you that our problem is not current account deficit, but capital flows. And India has seen capital outflows for the past 2 years in a row. Do you see this changing in 2026?
If you look at the growth numbers, and again, let's go with the official growth numbers. Let's get into a debate about what the real growth number is, right? Let's go with the official growth numbers. These are spectacular growth numbers, right? We've always been told, well, capital flows are essentially driven by growth differential. Look at the growth differential. Rarely have had, and you have to go back to 2005s and 6s and 7s to get these kinds of growth differential with the rest of the world, right? China is at about 4.5%, 5%, right? I mean, even with China, we have a 300 basis points of growth differential. Yes. So with these differentials we can't attract portfolio inflows, then the problem isn't with the growth differentials per se. We need to look at other things. And here is my non-equity analyst view. So just don't hold me to it. My equity analysts will throw a fit if they hear this, right? Here's my problem. Nobody invests in a country. People invest in companies. So tell me a company in India, which is, let's say, $200, $300 billion company that has a prospects over the next 10 years to become a $1 trillion, $2 trillion company. That's what attracted all the capital flows into AI in the US, AI-related stocks. If we do not have companies of that stature, then where will foreigners or anyone invest in? If you look at the emerging market world, once you've taken out China, which got taken out in 2020 because of all the policy decisions that they made, you have taken out from the emerging market world companies that are capable of multi-year growth and becoming trillion-dollar companies. But if you don't have that, then where will people invest? No one really invests in a country, right? You invest in particular companies and stocks, right?
Yes.
But if you don't have that, so if India is unable to deliver, India has what, hundreds of thousands of startups, right? Almost every day somebody gets IPO'd.
Yes.
Yet, we aren't able to hone into 1, 2, 3 companies that are going to become trillion-dollar companies in about a year's time. If you don't have that, then where will the money come into?
Okay, earnings growth is expected to pick up. I mean, for banks, for instance, as the rate cycle ends, expectations are their margins and credit growth will improve. So my question is, assuming the AI trade unwinds or at least dulls and earnings picks up somewhat, do you see the FPI flows back in 2026?
You talked about, that this is not a one-year phenomenon, right? You go back to last year, the year before that, right?
Yes.
We didn't have any AI trade then, did we?
No.
And if we didn't have any AI trade then, India did not attract the kind of inflows that India typically used to attract 10 years back, 15 years back, right? As percentage of GDP, let's say, not in terms of absolute dollars, right?
Yeah.
Obviously, the dollar amount has gone up. Then again, you're back to looking at ad hoc explanations for things that are not any longer ad hoc. These are structural issues. And if we don't address these structural issues, I do not think you can have episodically, you will get money coming into India. But you have to create companies, you have to create assets that have the prospect of moving up 4, 5, 6 times. Indian banks, you can tell me, and correct me if I'm wrong, I don't think any Indian bank, somebody will look at and say, you know what, in 10 years' time, their market cap is going to rise by 5 times.
No, not that much. But anyway, speaking of earnings growth, are you saying you're not very sure that if the AI, won't deliver, then we are not going to get funds?
Yeah. I mean, when we talk about the AI trade dampening out in the US, we should have been part of the AI trade in India, right? They are not part of the AI trade. I mean, it was supposed to be, China is the one that created the DeepSeeks and the Kimkis of the world. We didn't create the DeepSeeks and the Kimkis of the world.
Yeah, we are excluded from the AI trade. Well, actually, let's come to inflation. Inflation has been unusually low in 2025. Do you think this continues in 26? And by the way, do you think this is explained by Asian disinflation, or is there a problem of slack demand in India too?
So my sense is that, look, so there are 2 different factors is driving the low inflation. One is a genuine factor, right? So you have a good monsoons. The food prices are down, not down. Food price inflation is down, and you've had core inflation going down for the last 19, 20, 24 months, right? And then there's a base effect. I think that on the base effect, there will be a turnaround that will take place starting maybe in the first quarter of 2026. We are expecting that base effect to be large enough to take inflation back up into the range of 4s, 4.5s in 2026. So yes, on the base effect, it will go up. But clearly the problem is going to be on core inflation. Core inflation hasn't shown any real signs of recovering with any strength. And we've spoken about this many, many times, that if you have a systematic decline in core inflation, then almost always it is a telltale sign that there is a massive slack in the economy, and that slack is not going away anywhere.
Oh, so you are saying that low inflation is reflecting domestic demand slackness, not just Asian disinflation?
So I'm looking at both factors. So I'm looking at basically a core inflation. So part of the core inflation that has declined, that has taken place, is undoubtedly the fact that China has been exporting disinflation for not just last year, for about 2.5, 3 years. In fact, since it opened up after the pandemic, right? So that is clearly a factor. But if you look at that driver, which is export prices coming out of China. Chinese export prices are still negative, but they are no longer as negative as they used to be about 6-9 months back, which was running at -7, -8. Now they're running at -2, -3. But that deflationary impulse is still going through to the extent that Indian consumer goods, a large chunk of that, and Indian intermediate goods, a large chunk of that, comes from China. That will persist. But even if you strip that out, there is still a very large part of core inflation decline that can't be explained by Chinese prices. And that has to be because you have a very, very large slack in the economy, and that slack clearly is not going away. And the corroborating evidence or the proof of the pudding is the fact that corporate investment isn't picking up in India, largely because they already have excess capacity.
Okay. Well, thank you very much. Out of time, Jahangir, but basically for an 8% economy, if you're speaking of slack demand, then maybe it is the K-shaped recovery. Thank you very much for joining us and for staying up for us. Have to wrap up on Bazaar. Chat Past is coming up.